Gold rallying this Wednesday, hitting 1273 an ounce. That's close to a 2-month high as tensions with North Korea escalate. So what's in store for the precious metal? Vince Lanci of Echo Bay Partners and a contributor to MarketsLatin.com joins us now. Vince, happy to see you again.
Happy to see you. I hope you enjoyed your time off.
I did. Good to be back, especially with gold now hitting its highest level in almost 2 months. This, of course, against the backdrop of U.S. Secretary of State Rex Tillerson reassuring Americans they should sleep well at night after threats made by North Korea. So, is it purely a sign of gold showing its safe haven strength here?
Yes, it's actually a weird combination of gold showing safe haven strength, even while directly you would say gold is showing safe haven strength. If that is true, then why is the dollar not stronger? So today, just for today, you would say gold is higher on dollar weakness because the euro has been benefiting from dollar weakness recently. I think the answer to that question lies in the next leg of the dollar. If people start piling into the dollar and gold keeps gains and rallies more, then you could definitely call it safe haven, and it wouldn't just be a soundbite.
So, Vince, I guess my next question is pretty loaded. With the rally we've seen, why haven't we been able to maintain a consistent momentum to get gold back to 1900 of once upon a time?
Well, keeping in mind that I'm a biased bull, so that'll affect my answer. I'm more likely to buy dips than to sell rallies. The answer, I was very actively trading at the time when the market made that move. And it seemed a couple things were on the table that are not on the table now. The big funds were not as, I believe, educated as to the lack of liquidity in gold. And at the time, if you remember, Paulson, who had just made a killing in the mortgage markets, was buying gold, a hand over fist. And I was witnessing this and saw his order flow getting spoofed by people handling it. So I think my answer to your question is the buyers at that time were buying into strength. They were less price sensitive because they were buying on the back of recent successes. So guys like Paulson, maybe their ego got a little bit ahead of themselves. Banks and dealers probably had a field day buying in front of them and then selling them higher. And then I believe ultimately, in defense of the Fed, the quantitative easing, which was feared to be a large inflationary driver, turned out to not be as much as people thought. So when you combine non-price sensitive buying from guys like Paulson, buy it, I don't care what the price is, with inflationary numbers, cooked or not, that remain low, and you have a whole generation of new gold bugs, they're not aware that exiting gold or gold exit liquidity is not always there. I think you've scared away a lot of trading money. So to answer your question,
right.
1900 is definitely on the table, and it will not come like it did last time.
You need a lot of elements to make that equation work, basically. You mentioned the Fed, you mentioned big names, you mentioned a new generation of gold aficionados here.
Yes, I did. So that makes it kind of convoluted. I would defend myself, even though you're not attacking me. The Fed doing well, or at least perceiving themselves to do well, or the market perceiving, is the bucket just being kicked down the road. So I would say that 1900 is the tip of the iceberg when things finally take their ultimate path.
All right.
Otherwise, it's just markets being front run as usual.
Let's look at the stock market now and how it's affecting gold. Vince, I know you have a lot to say on this topic. What's your take here, and how can it help move the metal?
Yeah, that's the lesson. The first lesson I learned was as a witness, watching how in 1987 during that crash, gold was actually sold after a rally because people had to take off their hedges to their gold hedge to buy to keep their margins in stock liquid. But if you look at I think a 2,000 point drop in the Dow, the last 2,000 point drop in the Dow we had, 2008, I think. it was accompanied with a 25% or 30% rally in precious metals. So not speaking about the miners themselves, but I think the drivers of the next crisis or 2,000 to 5,000 point move lower, gold will move as it should inversely. If it does not move inversely initially, buy the dip. That's what I would say, because that's irrational selling, and the demand for physical isn't going away in the Far East.
So I'm sensing you're happy with what you're seeing on the gold front thus far, Vince.
Yes, I am. But let's be clear. You made a point earlier. I think that's really important to understand. We are at very low volatility. Gold has been in a sideways range for since 2012. If you really look at the wider range, so it is not back where it should be, considering that the world is no safer a place. I don't know how long that can last. So I'm not happy with the price, but I am happy with the situation not being resolved. I don't trust the people in charge. So you still have to be long gold.
Vince, good thoughts from you today. Thanks so much for joining us.
Thank you.
And thanks for watching. We'll be back tomorrow.